Nitin, if I may go on to yourself, as an investment banker and a veteran investment banker, could you do a quick walkthrough to the audience on a process to be followed and give a high-level, response for raising money on these platforms? What all they need to address, just in a sense of timing, and a sense of process, and a sense of cost, so they know how this whole thing will happen.
Yeah, what I could do is, possibly take a step back. When I look at investment bankers like us, this audience is largely, I would call, a pool of audience, a client base which is seeking capital. And then there's a pool on the other side, which are providers of capital. Invariably, in my experience, I've seen more than 90-95% of the cases, it is a seeker of capital, he is going to the provider of capital. And invariably, there is a difficulty of the pool of capital which is available being able to speak the same language as a seeker of capital. And as one of the earlier panel members was saying, this world's going more towards mediocrity. So it's becoming more and more analytical, rigor going into how deals are being evaluated. And Sanjay, you were asking how much of this audience is entrepreneurs, how much are SMEs. When we look at the financial markets in India, when you look at entrepreneurs, the early stage, pre-early stage, more of concept stage funding, I would say is more or less non-existent. So typically we call it the 3 Fs, friends, families, and fools, where you try and raise capital from. So once you've reached some kind of early stage proof of concept, then you talk about seed stage funding. Still early days, but yes, there is some movement on the ground as far as seed stage goes. Venture capital and private equity has been around for a while. So yes, there is capital available, but as Saji was also mentioning, there has to be a very specific, well thought out case before you go and approach an investor as to what is the case that you're presenting to the investor as to why he should be coming and backing you. And as Sanjay, you were also saying, valuations is important, but it is not a critical factor when you're looking at growth. So the trade-off invariably we've seen with promoters and entrepreneurs is they are invariably very conflicted with the quantum of dilution that they are willing to forego vis-a-vis the business growth and the potential in the business that they're foreseeing in the future. So that's a call that entrepreneurs and promoters need to take very consciously. And coming to your question about how they should be going about it, it's a reasonably fairly comprehensive checklist that investors come with. And when we look at, I'm not coming on the banking side, but when you look at equity, equity is about risk capital. So increasingly the amount of risk that investors are looking at has reduced in terms of being able to quantify what the risks are vis-a-vis the returns. So coming back, there's much more analytical rigor that's happening on the investor side. So as seekers of capital, we also need to be appreciative of their perspective, how they're going about the analysis piece, and we need to provide them comfort as well. So, having seen this industry evolve, early days, maybe it would be a 50-50 call where equity investors saying, I'm taking a call on the person, I'm taking a call on the business. So 50% is analytical Excel spreadsheet where you're going through the assumptions, trying to converge on the assumptions and then arrive at what the business case is about, but it's still a gut call end of the day. So increasingly gut calls have started reducing, and it's becoming more about Excel spreadsheets and how do you ensure that you're able to cover the dots and cross the T's.
Thanks, Nitin. Mr. Ravishankar, as a virtual doyen in the credit rating side of business, you've been through both the debt and equity side. I think it'll be very helpful for you to throw some light on the relevance of rating, both for debt and equity, and also the perception of capital market and the players towards SMEs.
Thank you. Okay.
Yes, we can hear you, sir.
No, I just continue from what Mr. Nitin was talking about from the seekers of fund perspective. I'll talk from a perspective of providers of funds, particularly the traditional route, that is bankers. What we did was, in the last 18 months or so, we have done around 3,000 plus companies rating of SMEs. And the largest users of rating is the bankers, because what the bank does is, before lending, in addition to their own internal process, they look at the credit rating as an additional opinion. So then we tried to do a small survey. Then from a banker's perspective, what are those things that they are looking at from SMEs? I just summarized some of the, what you call the study what we have done. We try to take more from a perspective of their perceptions or the challenges what they see while lending. Because quite often, on the other hand, we found that the SMEs perspective, they always say that they don't get access to funds. On the other hand, we found that bankers are sitting on a lot of money, but why they are not lending. So the first perception is that the owners quite often mingle their so-called funds between the personal funds and the business funds. So this is one challenge what they find. It is very difficult to rely upon the numbers, because quite often you'll find the funds are interchanged. That's the first difficulty they have. The second is they're not able to clearly find from SME what is a single success factor, critical success factors while running the business of SME. They are not able to clearly identify. Why I'm highlighting is this: some of the SMEs who are here possibly look at from a banker's perspective what are those expectations, and if we can communicate to them, it will be very useful. The third is, of course, unlike a large listed company where you find a lot of research information is available. For example, Mr. Ashish was saying the benefit of listing. Wherever you find that there are companies are listed, there's a lot of analysts who come and cover that company in terms of research. So when a banker goes and lends money, he's already having a primary research information available through the market information. Whereas in the case of SME, very little information is available for a banker. So he has to solely rely upon his own assessment. He doesn't have additional information. So this is third area where they find that since very little information is available, how can we lend? Fourth, of course, is the transaction cost. Yeah, bankers are primarily in the business of taking deposits and finally lending back. In that whole process, they survive on a spread. On the spread, when you look at, they have to take into account various other charges. Whereas when they lend money to SMEs, they find that transaction cost is higher as compared to lending to a large entity. Because the smaller the size of the funds, the recovery of the expenses as a percentage of the income seems to be very high. And then fourth, of course, is one of the critical challenges, the financial numbers, whatever is provided by an SME. It's always the reliability of the information. They find they have some difficulty to accept the numbers. Either it doesn't meet the generally accepted principles of accounting, or else there is a lot of financial engineering which happens at the time of finalizing the accounts. This is a very critical view which they have given. And one more is a banker, what happens is, in addition, whatever money which they lend, they also need to provide capital. So when a company is rated, a small entity generally commands a lower rating. When a company commands a low rating, the capital that they have to set aside in terms of for such type of SME lending is higher than what they provide for a large entity. So in other words, the spreads come down if they provide a higher capital for small entities. And the lack of collateral. Quite often you will find a lot of entities in the services sector or even in the manufacturing sector. The type of collateral generally what a large entity provides, a very similar type of collaterals are not available, because the bankers' lending is largely based on collateral. They don't lend sort of unsecured lending. That share of lending is very small. Of course, one of the other thing is, after all, they find that the ticket size is very small. Why should I spend time if I lend 100 clients for 1 crore? That is equivalent to 100 crores. Whereas if I lend to a large entity, 1 client, I am able to lend the entire 100 crores or even 500 crores. So the effectively coming back to the transaction size and as well as the type of effort what they have to put to lend money is this. And finally, one of the other point is the small entities are susceptible to vulnerability in the economy. Whenever the economy is volatile, you find that such of those small entities, particularly a weaker financials, wherever companies are having weaker financials, they find it they are much more vulnerable. So whenever there is a vulnerability, then the risk of defaults were also very high. The other general things like the outdated technology, the ability of the small entity to keep on updating the technology, etc. These are other challenges. So I just stop it here because we can cover the rest of it. So
Right.
I'm just purely summarized from a perspective of a traditional provider of funds, that is banker. And banker is one of the largest provider in the entire funding segment. I'm sure that these perspectives could be captured.
So just one last thing, that is it fair to summarize by saying that despite the good and the bad, there is enough availability of easy debt? I'm not saying very easy, but easy debt for SMEs in India?
Absolutely. So if you carefully analyze, then there are a number of initiatives taken by the government of India, as well as Reserve Bank of India. A few months before, even SMEs are classified under the priority sector lending, which means the banker has to have a certain percentage of their overall portfolio exposed to SMEs. So that is first level, is a major initiative. The second, of course, is in terms of promotions, the various activities related to promoting the entities. There are different, one of those is, the SIDBI has a scheme where up to 10 lakhs exposure by a bank, they provide guarantees. In other words, even without a collateral, an entity can go and access funds from a banker up to 10 lakh rupees, and in turn it is provided in the form of a guarantee by SIDBI. So the bankers are very comfortable to lend that amount without collaterals. So we find there are many opportunities for from a banker perspective. Certainly, if you look at a overall portfolio, what was year on year, whether the lending to large segment is increasing or not, the lending to SME segment, in terms of absolute number, it has only increased.
Thank you, Mr. Ravishankar. With that, we will be bringing our session to a close.